But talk about a difference in fortunes. It's now only valued at 80 million. Turnover almost double that of Warpaint. So you have one business making great margins and another in the same sector, UK, equally as visible or even more visible, decent presence in the United States, which can't make a bean, barely scrapes a profit.
Hello and welcome to the Investors Champion podcast. The goal of this podcast is to give you a quick but informative rundown of some interesting topics affecting UK investors and a rundown of the biggest movers in the UK share market, including AIM and some bonkers bargains for you to take a closer look at. Let's get started. Hello, Chris. Good to see you again.
Hello, Lee. Nice to be here. Sunny times at the moment, which is good news.
Yes, and I think this podcast is going to be mainly about AIM and small caps, isn't it?
Yeah, I think there's a lot to discuss, a lot of these interesting and sometimes bizarre business models that I think it's worth going over, and some strange valuations, some good news, some indifferent news. And yeah, I just thought it'll be a week maybe dedicated to smaller companies and AIM, all of which are pretty interesting, I think.
Yeah, so I'll just quickly run through some of the companies we're going to discuss. So we're going to discuss YouGov's profit warning. We've got franchise brands, Warpaint London and Revolution Beauty. We've got some good news from Intercede, which we touched on last week. And then we've got more news and analysis for Chapel Down, Gear for Music, Supreme, Time Finance, and PCI PAL. There's a lot to discuss there. Before we get into all that, we've got another takeover, haven't we, unfortunately, for Britvic, potentially.
Yeah, cheeky bid from Carlsberg. Carlsberg, the brewing giant, has made a cheeky bid twice. Apparently, it's gone and it's upped its offer for Britvic, the soft drinks business. Got some great brands, Robinson's, Tango, and it also bottles for PepsiCo. Yeah, Britvic board has said no way, that it significantly undervalues Britvic. That's good, so they've kicked that out. Subsequently, Carlsberg, though, has come back and said, look, it's actually secured behind the scenes agreement with PepsiCo that PepsiCo wouldn't be against the deal. So I think this one's going to run, and now it's a matter of how much Carlsberg is willing to pay up. Clearly more than it's currently asking.
Unfortunately, there could be another one leaving.
Yeah, it'll be another shame. £3.5 billion business, Britvic. Nice little business. For those that are interested in the space, beverages, I would implore you to look at Nichols Group. Nichols, which has a great brand in Vimto. It also has some other sort of smaller brands as well. But yeah, Nichols is looking reasonably good value. Unlike Britvic, Nichols has got a decent net cash position. Valuation measures are quite similar. It's tidying itself up. Part of its business has been a bit of a mess or slower growth, but Nichols has been going great guns in overseas markets, been so really fast. So yeah, have a look at Nichols if you like the beverage space.
Brilliant. The next company we're going to touch on, which is YouGov, unfortunately had some disappointing results and it's certainly affected the share price. And this was a question that came in from one of the YouTube followers. So thank you for that. And if anyone does have any questions or any comments, please do leave them in the YouTube or in the podcast platforms and we'll do our best to answer them on the podcast for you. And Fundamental is a holder of YouGov, aren't they?
Yeah, we hold it in our fundamental regulated businesses, AIM portfolio services. We haven't been a holder for many years. It's a decent stock, large company, well known for its polling business, which isn't actually what it's about. It's more about research and data that it applies to corporate customers. But it's ironic, isn't it? At a time when it's getting more exposure around election year, comes out with a profit warning. It's typical of what's been happening. Smaller company comes out with a warning. It wasn't so bad at the top line revenue level, but that's felt more heavily on the profit line. It's circa just under 30% profit miss, has subsequently seen a near 50% decline in its share price. We feel it looks oversold now massively. This is a good business with terrific international presence, great exposure to the Americas. Its co-founder is now, Stephen Shakespeare, is now non-exec chairman. He sold some shares a few months ago at levels more than twice where the share price is now, so that's probably hasn't gone down that well. The one fear we have with this business is it's made a very large acquisition a few months ago of the consumer panels services activities of a business called GfK. It cost them 350 million euros and it paid for it with debt and largely debt. And it moved it in the business. YouGov moved from a cash position to a net debted position. Is this an excuse? Was this an indication that their core activities growth was slowing? And so they were forced into this deal really to mask greater problems. I don't know. But it does worry me when smallish companies go for these big transformational takeovers. They never seemingly do them very well. They never integrate them very well. It's much better when they do small bolt-on deals rather than a big thing like this. They have said that the acquisition's integrating fine. But yeah, I hope it's not a sign of greater problems. But yeah, our view currently on YouGov, wow, the shares have been more than cut in half over recent months. It's still a good business. It's built up this panel of consumer panel, 27 million people around the world, about a third of which are in the Americas, who they have to pay to submit research. And that gives them terrific insight in consumer behavior. And that is a real embedded value. They paid a lot of money over the years for their so-called panelists. And that's hard to replicate quickly. So that's the real embedded value in this business. But yeah, watch this space. I just hope there are no more problems in the woodwork that may come out as a result of the deal. But yeah, interesting business still, and we remain holders and are buying for our new accounts.
So, I mean, asking the simple question here, why is it that they've released a profit warning, given that probably you would think that this would be their busiest time? We've got elections here in the UK, in America.
They don't actually generate, per se, much money out of the election. It's good for their profile in terms of polling. Most of their work comes from, most of their earnings and revenue comes from pretty standard B2B research offerings built around the consumer knowledge and all the data they're collecting. The polling bit is more the sort of cherry on the top, and in terms of profile. But as I say, it is somewhat ironic that it's happening at this time, the profit warning.
Given that Fundamental is a holder, what would you like to see to demonstrate that either things are improving and perhaps maybe the profit warning was a one-off, or that actually this is looking like a trend and we might need to take further action here?
I think it's the key thing for us, which we're reassured with, is that the acquisition seems to be going okay. If they were highlighting problems, that would be the greatest concern. They have said
what sort of problems would they say? What sort of things?
Integration problems, excessive restructuring costs, slowdown in growth. They have said they've kicked some of the revenue associated with the acquisition to next year. Hopefully that isn't a sign of problems in that. It is just a delay, a timing delay. And if you see big management reshuffle as a result of the acquisition, what always annoys me with these deals is whatever the cost of the deal is, the subsequent restructuring costs are often ludicrous. I hope this isn't the case here. And there will also be some cost synergies coming through, cost savings, which they've intimated will be the case, in which case it were positive. But this is such a big deal, 350 million euros for a business that at the time was valued at, I don't know, about 700 million pounds. It's a big acquisition for a small company. The other slight issue is the move, newish CEO for us, founder dropping to non-exec chairman, founder selling a big tranche of shares now. He or his family own, I think, less than 2%. That's never a fabulous sign for us. I like founders staying involved, actively involved, not in non-exec roles. But conceivably a lot of bad news seemingly in the price now.
And I guess that's always the thing, isn't it? Has it actually oversold now? That's the question, isn't it?
That's been the case with so many of these more liquid AIM stocks, these smaller companies, that the selling just clearly some quite short-term traders in there. I've heard there has been some American hedge fund groups buying into YouGov who bang, then they're in and they're out almost immediately. They see this and bang, we're off to the next deal. Might be vulnerable to takeover at this level, but would an acquirer be interested when they've just done this big acquisition? The acquirer will probably want to see it's settling down all right as well.
You're saying that the acquisition, it needs to be given more time to make sure that what they've acquired is actually going to be beneficial to the company long term.
Yeah. That's the other thing. This is real short-terming. If you're looking at this over such a short-term basis when they've done such a big deal and there's such a big change afoot. So this business, you've got to look 3-4 years out. To just to look at short-term earnings is ludicrous, especially when they've had such a big acquisition.
You mentioned there Stephen Shakespeare. He mentioned last year in an interview that he was considering moving the listing to the US, as it's where they work with many technology companies and consumer brands, and it's also the biggest market. Yeah, slightly paraphrasing there, but he did say he was looking at moving to the US.
It's going to be even more inclined now.
Yeah, that's what I was thinking.
Although anecdotally, we hear it's probably US fund managers have instigated this sharp sell-off. They're probably the biggest cause of it. So watch out. If you fail in the US as well, not many places to hide either. And it's all about growth. You're going to get a reward, but you need to keep demonstrating growth. But yeah, we're still holders, and we think it does look pretty oversold at this level.
Yeah, thank you for the question on YouTube about that. And as I've said, reiterate, please do keep them coming and we'll do our best to answer them as best we can for you. So next company is Franchise Brands.
Yeah, I thought it was worth bringing this up. I'd be interested if listeners, any come back to me. This is a franchise business, and it's what you call one of these buy and builds, which we aren't big fans of. It's the creation of a gentleman called Stephen Hemsley, who has had a terrific reputation. He was the CEO for a long time and then chairman of Domino's Pizza UK. And he was in charge when Domino's Pizza UK was absolutely flying. This was many years ago. But he's now created this. Now, I've got a lot of respect for Stephen. He's clearly a great manager, but he's created this new franchise operation. Domino's UK was also a franchise business, but correct me if I'm wrong, Domino's Pizza was focused on the pizza business.
Yes.
This new creation, it's a host of different offerings in numerous markets. They bought this big thing called Pertec, which is an on-site hydraulic hose replacement services, right? You've got that bit. Then you have in water and waste services, you have Metro Rod, Metro Plum, Willow Pumps. Then you have another business called Filter, which deals with the waste from fryers. Then you have another business called Filter International, which sort of supports these fryers, deep fat fryers, largely in the United States, North America. You can imagine, apparently they support football stadiums and things, which are full of these fryers. They have contracts to clean them, service them, blah, blah, blah. So you've got that business. Then the starting point for all this accumulation were businesses called Chips Away, Oven Clean, and wait for it, this is a cracker, Barking Mad. This is a dog sitting service. Yeah. So this is their business to consumer. And this is where the whole Franchise Brands created was started within the business to consumer. And they've then pivoted away to the business to business in all these other areas. I haven't got a clue of what this cabal is, the logic or the rationality for this thing. I'm sure Mr. Hemsley does, and we might be interested in having a meeting. You also have another thing called Azura, which is a software supplier of franchise management software to all of them. Anyway, I just do not get the common theme among this lot. I always thought the secret to business success was focus, and this business seems to lack focus at all in any particular area.
I wonder if, as a result of this, the actual software they developed to manage all these different franchises will be the software they can sell to other franchise companies.
Yeah, maybe that's the secret sauce. Yeah, maybe the tiny Azura bit, which generates tiny revenues at the moment relative to the rest, is actually
that'll be the golden goose.
Yeah, but somebody help us. Wow. On paper, this looks bonkers. I'm sure that Mr. Hemsley will present a great story and presentation and explain it in detail, the rationality of this thing. But it looks pretty bizarre to me on at first glance.
What have the numbers been like for this company?
Well, system sales, that's all of everything. That's all the franchisees were up 88% last year to 350 million. And if that translated for the actual listed group into their revenue of 121 million and adjusted profit before tax of just shy of 20. So you got a margin of 16%, but these deals have been debt funded, so they got quite a bit of debt, 100 million of debt to buy Pertec, which seems to be largely a European-based business. So again, it's not even UK focused. This is all over the shop. You've got stuff all over the place, which again looks a bit questionable. They've also in terms of outlook, they've commented on a slow start to the year, which isn't great, but I would say that's pretty short term. This has been built for the longer, but yeah, watch this space. I'm sure it'll be a great success, but there are potentially lots of areas where it could trip up.
One on the watch list then for now, maybe.
I'm watching it eagerly because, as I say, management have a great reputation. I think Nigel Ray's a big holder as well. He's been quite a shrewd backer of businesses, and Ray and Hemsley have been Domino's. He made a lot of money, and Ray and Hemsley have been there before. There's some clever people there, some shrewd investors.
You can see how you could create quite a good narrative around the potential success of this, couldn't you? Because it's almost, they could expand into whatever area they want, couldn't they, in theory, with the way that they're going? Domino's Pizzas was Domino's Pizzas, McDonald's is McDonald's, Intercontinental Hotels is, as it says, hotels. But what these are doing here is these are saying, we can actually bolt anything on. We can buy any company and bolt it on as a franchisee. So potentially, the upside is limitless.
Yeah. Theirs is
So
a
you,
franchise holding company with lots of different
lots of things. So
franchise which they think could work. But it's the risk that you become a jack of all trades and master of none. You're not really any brilliance at anything.
mm,
I love franchise businesses when they work, but normally they're pretty focused franchise businesses. This
mm.
thing has lots and lots of different franchise operations. It's clearly what they want to get rid of, or they were trying to get rid of the business to consumer bit. They don't good at all, barking mad, oven clean chips away. I don't know. Clearly they need to get rid of those, but they couldn't, so they're stuck with them for now. Yeah, and they cover themselves. That's fine. But yeah, it's an odd one.
Shall we move on then? Going to contrast two companies here, aren't we? Warpaint London and Revolution Beauty. I can just imagine you're a regular shopper at these two, Chris.
Yeah, they're actually retailers. They supply their brands, their cosmetics into retailers. I think Superdrug is a stock. It's a both, or like a Tesco as well. Stocks W7L and sort of Revolution Beauty. But yeah, I just think it's really interesting. Warpaint we hold on our income portfolio. Warpaint has offered a decent dividend. We bought into it when the shares were pretty attractive and the yield was great. It's just doing fantastically. So it owns the W7 and Technique brands. And what I just think is incredible with these two companies, both Warpaint and Revolution Beauty, is the contrasting fortunes. They're both not really high-end cosmetics. Warpaint is particularly low business, and W7 is low at lower ends. But Warpaint business is just fantastic. Sales are growing fast. Margins are 26%. It's increase in sales about for the current year being about just over 100 million, grew 17%. Revenue from the US is still quite small, but it's growing fast there. So you've got this Warpaint business still run by its co-founders who started off selling from market stalls, I think, know the business clearly inside out, hold significant stakes, or they've sold down. Now Warpaint has got a market capitalization of 450 odd million on revenues 105. Its rating looks quite full, but it hasn't missed a beat. And then on the other side, you have Revolution Beauty, which ironically listed on the stock market in 2021 at a similar valuation to Warpaint's currently, around about 450 million. But talk about a difference in fortunes. It's now only valued at 80 million. Turnover almost double that of Warpaint. So you have one business making great margins and another in the same sector, UK, equally as visible or even more visible, decent presence in the United States, which can't make a bean, barely scrapes a profit. It's had problems as well. Its co-founder has left, or its two founders have gone. It's had new management, and it's a real recovery story. But what gets me, how can a company that with 200 million of revenue barely turn over a profit? I think even in 2 years' time, it's only forecast to generate about 5 million of pre-tax profits on 200 odd million of revenue. Something is going badly wrong in this business somewhere.
Why did the founders leave? What is there a story there? Or?
I think there was some controversy surrounding their actions. They also owned another business that Revolution Beauty bought, and there was some issues around that. It was a whole load of problems. Paint is in a nice net cash position. Revolution Beauty is carrying quite a lot of debt. Clearly, when it listed on the stock market, and we were amazed as well at the valuation because it hadn't made many money then, and its valuation looked crazy to us. It was one of these private equity dumps on the stock market, I call them, where private equity ran out and thankless sort of public markets holders were stuck with the shares or bought the shares foolishly. But yeah, it's positively, if it can turn things around, if it can address its cost base, it clearly knows how to sell the things, and it could be a decent recovery story here. But I think in isolation, the top line, it just looks bizarre how two very similar business offerings are achieving a different result.
Was it private equity that brought Warpaint?
No, it was a founder. It was very much a founder-led and I think funded business. And I think on listing, I think the founders sold out. It also had a hiccup as well, not long after it listed Warpaint. And it subsequently recovered really well. And the founders say have sold down somewhat, but they still remain fully involved and are clearly really capable managers and know how to run this business.
Hopefully Revolution Beauty can turn around and certainly get back up to where Warpaint is, and maybe
you can see the rewards if it does. You've got one that's trading on 4 times revenue, that's Warpaint, and another trading on 4 times forecast revenue. So you can see if Revolution Beauty can swing it around, the potential. I did a sort of sample purchase as well.
Here we go. This is what I was waiting for.
Yeah, I thought you might like this one. I looked for the absolutely waterproof mascara, which can be yours for £4.50 at Warpaint. Whereas Revolution Beauty's, what do they call it? It's 5D Whip Lift Waterproof Mascara is on sale at the reduced price of £6.69. So one business is selling £4.50 waterproof mascara, making a 26% margin, and the other is selling it at circa 50% more, not making any margin. What's going on? Somebody tell me, some cosmetics expert, sector expert, please tell me, please, what's going on here?
Did you try their quality? Did you actually try them on though, Chris? Maybe that's the difference. Maybe, I don't know what it's like to put them on. Did you try them on?
I haven't, not yet. That's currently a step too far.
Yeah, it might be.
For my family, I think, above anything else.
Yeah. Should we leave that one there? We'll move on to it.
Yeah, I think so.
Yeah.
Yeah, briefly, Intercede. As you said, we've mentioned it before, and we're a cybersecurity software company. And clearly, this business must have something really good. It's supplying a lot of federal agencies in the US, and it's just announced a new partnership with a big reseller of IT solutions to US government, and that could really propel it. Its offering is clearly pretty robust, its security offering, and now it's got the backing of a big reseller. So look out for Intercede. It may take a while to get going, but this could be good news for it in terms of sales and distribution in the biggest market of all.
That's brilliant news for a UK company. Well done, Intercede. And moving on to a company now that has just released some interesting news, shall we say. Chapel Down, they've announced they're going to do a strategic review, which has left a few people, including yourself, Chris, all scratching their heads.
Yeah, we've mentioned Chapel Down before. English winemaker. It's doing really well. It's got some nice products, brands growing, and it seems to have received a really good reception on the name. It's been very well received by shareholders, but bizarrely now it said it's going to conduct a strategic review, the outcome of which could be the sale of the business. And that implies that it needs more funding, and in normal terms, that would imply that the stock market wasn't willing to fund it. That's normally the implication, but I don't see that's the case. But yeah, all options are on the table. I just thought it was really odd timing to bring this up, but we'll see what happens. But it's been doing really nicely.
Is there no details on why they're conducting this?
No, it's been really quite vague. They've got big growth plans. They need to plant more vines and vineyards. They've got a new winery they need to finance. They need to put more money into marketing and branding. And the market's there to support that kind of thing. And it has been supportive of Chapel Down. And I don't quite know why they suddenly come out with this one.
Yeah, so I guess all we can do is wait for further information to come out from Chapel Down in exactly where they are and what they're thinking with this strategic review. And we'll keep everyone updated through the podcast as and when we hear anything. Yeah, so moving on from Chapel Down, we're going to move on to Gear for Music. What do you think of this business, Chris?
Yeah, Gear for Music. I like Gear for Music. A nice little business. I like its offering. It's got great ratings, great service. I bought some stuff from it over lockdown. It's a classic business that did very well over lockdown. And the key issue then was it didn't have to spend much on marketing. It was attracting customers because they wanted to buy things online. They wanted to play music at home. They didn't have anything else to do. So their cost of customer acquisition was really low. And the problem with this business is, from my perspective, its gross margins just seem too low to support an online offering. Its gross margins are only circa 27%. It's been trying to sell its own branded products at higher margins. So that's clearly proving a challenge. And it's the classic sort of business where the customer doesn't really return. You buy your keyboard or you buy your guitar, and when are you going to come back again to buy something else? Probably in a few years. So it's probably costing quite a lot to acquire that customer in terms of search and AdWords, whatever it is, and online marketing for a one-off use. What I felt, it gave us plenty of commercial sort of key performance indicators in its results, but it didn't actually spell out how much was being spent on advertising and marketing and what is the average cost of acquiring a customer. I think those are often key metrics for an online business. It's good to see. We weren't given that. But yeah, it would be great if it could work things out and work out how to generate a better return. The other thing it's launched into is a second-hand proposition. Again, we were told, given a little bit of information, they'd acquired over 7,500 second-hand items from customers, but we weren't actually told how many they sold. This was over a year ago. And the contribution, the margin these second-hand items were generating. So again, you're getting so much, but not a great deal.
I guess two of their biggest competitors will probably be eBay and Facebook Marketplace.
Yeah.
Many a times when people buy a guitar, a keyboard, a drum kit, and they have all the enthusiasm for the first 3 to 6 months, and then it sits there in the corner for 2 years, and next thing it's on eBay, isn't it, for half the price
Yeah,
or
yeah.
a third of the
That's
price.
that's the problem. So can they effectively resell that and achieve a decent margin? So something's got to change. The shares, they're quite well liked and quite well followed in the small cap arena. And I'd say the offering's really good and great service, decent prices seemingly. But yeah, how can you survive making tiny margins like this? They put a lot of investment into distribution infrastructure. They're trying to grow in Europe as well. I don't know how profitable that bit is really. It's been mostly a UK play, but clearly the market in the UK would be quite small and barely be warranted as a listed company. It was only UK based.
And then that's
Um,
why I was thinking, how much is the addressable market that they're trying to serve? Does it really warrant a listing?
Not currently. It went off like a train. The shares absolutely flew. And then you had the pandemic boost as well, where, as I say, it wasn't very expensive to acquire customers and market because everybody was stuck at home and all they were doing was surfing on the internet. And now it's back to the real world. It's quite tough.
Yeah, and buying instruments for the average public in a time where purse strings are quite tight, hundreds of pounds worth of keyboards and guitars probably may not be high on the priority maybe as well, given
Uh,
the tightening of the consumer's purse strings at the moment.
Yeah, no, I think you're right. It's a tricky one. I'd like it to succeed, but struggle to see how it can materially grow. Maybe they acquire or pounce and have another other more rounded offering for it, or more comprehensive offering. You can bolt in other products to the online offering. But it's a tricky one at the moment.
Yeah, agreed. Should we move on to another company, Supreme? What's your thoughts on them, Chris?
This is really one that will polarize opinion. It's
Mm.
interesting. It describes itself as a leading manufacturer, supplier, and brand owner of fast moving consumer goods. That's the headline you get. Yeah. You don't see anything else in the headline, but you don't have to dig very further to discover actually that it makes all its money out of vaping products. Clearly, many people are going to be uncomfortable buying the shares of a company making big profits from vaping. And this has been the profitable growth driver over recent years. It sells batteries and it's got lighting products and it's got energy sports drinks, but all the money this business makes is from vaping. And it's now made a acquisition of a business called Clearly Drinks for 15 million quid. And the stock market went, oh, whoopee do, this looks great news, and sent its shares higher. And for the life of me, I just don't get it. I'm clearly missing something. I must be stupid here because Clearly Drinks, it was established in 1885. Yeah, it's a brand owner. You may have heard of its brands, Perfectly Clear, Northumbria Spring, and Revolution Waves. Have you heard of them?
Oh, I've not heard of them, no.
That must be a challenge to be going for more than nigh on 140 years, and the brands aren't really well known. I mean, they clearly put much money into their brands, but they bottle for other people, and they also bottle and supply to Waitrose, Aldi, Tesco, all the supermarkets. But yeah, they bought this business, Supreme, to diversify clearly away from vaping. But you're recycling great margins, profitable growth, great returns on capital into something that's after cases, aren't you really? Into probably a low growth or admirable little water business. I struggle. You're a sin stock. I would say embrace it, quite frankly. That's the facts of it. If you're a Diageo, you make spirits. You're going to keep making spirits, and you're not going to suddenly diversify into, I don't know, pharmaceuticals, or you might do down the line, but it seems unlikely. This business is stuck with its vaping product. That's where it's making its money, and it seems to be a case where we commented on potential diversification, not diversification, investing for the sake of diversifying without fully thinking about the consequences. But who knows? It might be a success, but I didn't get it at first glance, and I don't get why the stock market is somewhat euphoric about this kind of deal.
Do you think they're concerned about the potential of further regulations around vaping? Because the government has certainly made noises around wanting to come down hard on the vaping market, haven't they?
I just think they are concerned about it, but you don't have to run off and buy something like this, do you? You can think
I would say
carefully,
not, no.
take your time, and in the meantime, why don't you do what the tobacco groups do? Pay out huge divvies to your shareholders. This business's rating is minuscule, or very low, sorry, trading at what 8.5 times forecast earnings relative to its growth, which is pretty good in the vaping front. It's modestly priced, but its dividend is really quite modest. Its yield's only 2.8%. I would be inclined to think about it. Look, we've got a problem here. We recognize it. Let's to attract holders, up our divvy payout to be a yield stock. It's clearly taken a different route. Management knows what it's doing. It's still founder run. Clearly done a great job. An entrepreneur that's done a terrific job. I just don't understand diversification for the sake of diversification's sake. It's surely got to stack up on the financial measures. There's no point recycling higher returns on capital to lower returns on capital. That seems just bonkers to me. And buying a low growth business like this, it's been around forever and a day. I think they're saying they're going to bolt it into their energy drinks business, which is also in a highly competitive market and doesn't appear to have many competitive edges over anybody else. I just question it. It just seems they seem very overeager to do things too quickly, and they could have chosen other areas and maybe paid up for it a bit more. 15 million quid, still quite a lot of money. You could have been prepared to pay up for something of a different capital structure or different returns. I may be very wrong. Who knows? Very likely.
Should we wrap it up then with two stonking small caps, Time Finance and PCI PAL?
One's a bonkers bargain, not a stonking small. Yeah,
one's a bonkers bargain.
Although it should be, I think, now reclassified as a stonking small cap.
There you go. So Time Finance then, bonkers bargain.
Yeah, it's so cheap. This is a specialist finance provider. The business sector, it has a host of sort of financing options, hard asset finance, invoice financing, and the shares are just so cheap, trading at less than, I think, 8 times forecast earnings now. It's just put up a great trading update, which is really promising, and I just think it good value still. Got another upgrade, but yeah, its lending book now is up to 200 million, its own lending book. Its revenue rose 20%, its pre-tax profits are up 38%, yet it's trading at a sub 8 times forward multiple. It doesn't offer a dividend, which you'd normally expect from this kind of company. But yeah, the shares are just fantastic value, I think. Even the arrears, you'd be slightly concerned a business like this, which is in lending more and more, that they may be pushing things a bit too much, and then the arrears may rise. But they've actually fallen. Net bad debts have actually reduced as well. So everything's going in the right direction. But you're getting a very cheap stock. So I'd implore people to look at our bonkers bargain. It's done really well for us, but yeah, it could continue to do a lot better.
And where can people learn more about it?
On the Investors Champion website, there's loads of information on it, on our bonkers bargains and stonking small caps.
And shall we finish off with PCI PAL? Some good news from PCI PAL?
Yeah, this poor business has been subject to a terrible sort of spurious patent claim from a rival, I think, backed by private equity, and it got thrown out in the UK courts first of all, and now they've reached settlement with this company for the US claim as well, and it's been a total waste of time and money. And poor old PCI PAL has been having to pay out to support this. It's clearly you never get back everything you've spent, and it hurts your business. But hopefully they can move forward now, and good on them. They held their ground, they held firm, and they've got some settlement, and now that's out of the way. But yeah, PCI PAL, one of our stonking small caps, it's in the area of payments, secure payment solutions for business communications. If you're on the phone and you need to pay something over the phone, they've got the system where you pay with your credit card, and it's very secure, all cloud-based now, and growing really fast. So good luck to them, and I wish them well.
And as with Time Finance, plenty of articles and reports on the Investors Champion website.
Loads on the website.
Brilliant. Thank you, Chris.
Thanks very much.
Well, that's it for today. Please subscribe for next week's episode as we will once again discuss global events, the UK share market, and some more bonkers bargains for you to take a closer look at. If you want to take a deeper dive into any of these topics and indeed more exciting and interesting companies, then please feel free to visit investorschampion.com to learn more. All the links are just in the show notes just below. Many thanks for listening, and we hope you have a great day.